Wednesday, October 6, 2021, Maneco 64, home of alternative economics and contrarian views. So if the energy crisis or squeeze wasn't bad enough, I think we're starting to see the beginnings of a credit squeeze. And why is that? Well, because I'm noticing that long-term yields for US Treasuries, for UK gilts, for all the other European government bond yields are starting to spike quite significantly. Yes, of course, historically, they're still very low, but in the bond market, the important thing is the pace of increase or the pace in decrease of yields. And I'm very familiar with the bond market. I worked for over 20 years as a futures and options broker, and I started out at a small private bank in Switzerland. But the focus of my business was the government bond market. That's what I mostly dealt in. Yes, I used to deal sometimes in stock market indices for some of my bigger mutual fund institutional clients, but the core of my business was in bonds. So what you need to understand about the bond market and bond prices is that the bond market is where the price of money is determined. The price of money, of course, being yields or interest rates. What's the difference between yields and interest rates? Well, when a government issues a bond in the primary market, let's say a 10-year treasury is issued next week by the US Treasury, and they're able to issue it at 1.5% coupon. That's the interest that's going to be paid. But then when that treasury starts trading in the secondary market, the price of that treasury will move around from the par price that it's issued at, or 100, and let's say the price goes up to 102. The yield of that treasury will drop from 1.5 to, I don't know, 1.42. And conversely, if the price drops, if investors start selling those bonds, the price will drop below 100 and the yield will go up. So the next time the treasury issues treasuries or bonds, let's say the yield is at 2% because prices have dropped, they will have to pay 2%. So that's why it's so important to look at yields, what they're doing in the secondary market. Yes, the Federal Reserve and all the major central banks have set their benchmark overnight rate. That's usually what it is, an overnight rate. Fed funds or the UK Bank of England base rate, they're like at 0. In Europe, they're even negative. But bond investors right now, yes, they're losing faith and confidence, I think, in the central bankers. And many people might say, well, they can just come in now and start doing more QE, increasing the QE, and start to buy these bonds, these government bonds. Well, they've been talking about tapering and even raising interest rates. How much credibility would they have if they came out and said, oh, we're not thinking about tapering anymore, we're gonna do even more QE because there's so much inflation and bond prices are falling, yields are going up. It would really dent their credibility. So they're really cornered right now. The other thing that government bond yields do, because they're usually the benchmark for all other bond markets. And what do I mean by that? Well, you've got the mortgage bond market, we've got corporate bond market, we've got emerging market bond markets, all kinds of other markets. And the treasury yields are, of course, the benchmark for the world, seeing that the US is the reserve currency. But for the UK, it's the gilt market. And the other thing it will do, it will translate into higher rates for mortgages. That's a bad thing for the UK economy, which is so dependent on housing and higher house prices. aside from the energy squeeze that we're seeing higher prices, which is the consequence of all these years of money printing or inflation. We're going to see higher taxes as well, higher utility bills. So the perfect storm is starting, and this could be just a blip here in bond yields, but from my years of experience in the bond market, it doesn't look very good. So we're quickly going to look at these yields today. We usually just look at the U.S. Treasury yield, and it's not just me raising red flags. We're seeing the FT yesterday. They spoke about this in an article. They said record gas prices hit bonds as investors fear wider damage. Cost of Europe's natural gas contracts soar 23%, prompting UK government gilt sell-off. That's very serious. The other problem this creates is for the government, not just the UK government, all these governments in the US and in Europe, because the higher the cost of borrowing goes, the bigger their deficits are going to be. It's really a vicious circle when interest rates start going up. And some of you might ask, and I'm going to go into this question before I start looking at the yields. Well, gold and silver are going to do badly when interest rates rise or yields rise, when bond prices go down. Well, since 1980, that might have been true because people had faith and confidence, or have had more faith and confidence in central banks. And when yields went up, it was in a controlled way. But I have a feeling with all the rising prices that we're getting, with the currencies really collapsing versus commodities, because that's what's happening. It's not commodities going up. I think this time it will be different. And as you can see here, by this chart of the 10-year yield, US 10-year yield, constant maturity rate, from 1971, I'm going to take 71, March 71, which was just before Richard Nixon closed the gold window. The 10-year yield was at 553, and the price of gold was at $35 an ounce. That's how much you could exchange gold, right? Or redeem gold at the US Treasury. And then by the end of the decade, by 1980, 1981, interest rates had risen to above 16%, the 10-year yield, or I think it was 16% or thereabouts. And gold had gone to almost 900. So you can see that in this case, gold went up with interest rates going up. And why was that? Well, because central bankers were behind the curve. They couldn't raise rate as quickly in order to keep the real rate positive. So all throughout the 70s, the real rate of treasury yields were negative because they were behind the curve. And can you imagine central banks now raising rates above 4, 5, 6%, because that's really where the rate of price rises are around those levels. They're going to be behind the curve. And that's why I'm not concerned at all about having gold and silver. I'm concerned about having stocks and bonds right now. So enough of that. Let's quickly look at what I'm concerned about here. So I'm going to go to the UK 10-year yield, and right now it's up almost 5 basis points overnight. It's at 113, and I'll just show you a chart here of why it's getting serious. As you can see here, the low last year was almost at 0. We got to about 7 basis points, and the technical picture in terms of rising yields looks very bullish. I think we could very quickly get up to 1.5% and even 2% before the end of October. And if that happens, it's going to set the cats amongst the pigeons, so to speak. Even the US Treasury yields are rising quite significantly. Right now we're at 156. Yes, we're still below 175, which was the high earlier this year. But more worryingly, for the whole of Western Europe, for the whole of the world and the banking system, is what's happening as well in Europe. We're even seeing in Germany yields rise. Overnight, we were up 3.5 basis points. Yes, the 10-year yield for Germany is still negative, minus 0.15, but I think there's a lot of room. And as I said, the important thing here is the rate of increase of yields. France as well, we're seeing the same thing. 10-year yields up about 4 basis points. We're now at 0.2. Yes, it's well below the UK yield at 1.14 almost. And Italy as well. Italy is picking back up. The 10-year yield for Italy was at half a percent. As recently as in the beginning of August this year, and now we're at 0.91, and as you can see here by the chart, showing you the chart, it's starting to pick up. There's a lot of room on the upside. So all those economists, mainstream economists, central bankers, politicians who are saying that the economies are recovering, they're going to do really well, I think this is going to make it even worse. Why? Well, because as I've said many times, our economies nowadays are based on borrowing and lending and spending and credit. And if the cost of credit goes up like it's going up right now, and this is just the beginning, and as I said, it might be a blip, but I don't think it bodes well. There seems to be a squeeze in everything, not just natural resources. Now we're getting the credit squeeze. Yes, there's going to be a lot of people out there, the Keynesians especially, who are going to focus on the numbers. They're going to say, well, this is going to dampen demand, it's going to lower inflation, and bond yields are going to drop back. I saw the president of the one of the Fed presidents yesterday, I think it was the Chicago Fed, Evans, and he was saying, oh, we don't have a monetary problem. It's all a supply chain problem. Once the supply chain and all the shortages get sorted, we're going to have a problem keeping inflation at 2%. It's going to drop. Interest rates are historically low, and they're going to stay historically low. And the reporter didn't even ask him, what about all the money printing you've been doing, especially since March last year? Isn't that the reason why we're seeing all the supply shortages? Yeah, and for that, I actually recommend a really good video that Rafi Faber did yesterday. He did a weird analogy about the toilet paper clogging the toilet and what's happening to the world economy right now. And I don't think Mr. Evans will be watching that. They're deluded, the central bankers. They think that the real rate, or the neutral rate, they call it, I don't know where they get this neutral rate, long-term rate, is still going to be really low. They're trying to sell to investors that interest rates are going to stay down to near zero forever. But I think the market is saying otherwise, and the real world, Mr. Evans out there, is saying otherwise. Especially commodities, and it's not just because of the supply chain, it's because you stuffed too much funny money into an economy that was basically closed, and that money now is going everywhere, and that's what inflation is all about. So let's quickly look at where the markets are this morning. It's 8:30 London time, 8:30 a.m. We've got spot gold down $8.50 at $1751.50. As I said, I'm going to be patient because I know I'm right in terms of what's happening to the monetary system in terms of what they've been doing to the money, well, to the currency for so long. And there's only one way that the fiat currencies can go, and that's to worthlessness. And when that happens, you're going to want to have real money. Anyway, the high's been 1760, the low 1747. Silver's down 17 cents at 22.45. High's been 65, low 34. The Dow futures down 225 points. That's 2/3%. The NASDAQ is down 140 or 1%. S&P is down 0.8%. Usually when this happens, when the stock market drops like this, up until recently, we would see yields drop because the market would expect the Fed to remain quite dovish. But now we're getting the worst of both worlds. We're seeing the stock market drop and bond prices drop and yields go up. That's not a good combination. That's more like the 1970s stagflationary environment. The FTSE is down 87 points, back below 7,000. What about the currencies? Well, we're seeing sterling getting hit here. It's down 1/3% at 135.75. The euro is down 1/4%, 115.69. Dollar is up slightly versus the yen, 111.61. The dollar's up also slightly versus the yuan, 645.80. What about the Aussie dollar? Aussie dollar is down 0.75% at 72.38. The dollar is up 0.4 versus the Canadian dollar at 126.30. And the Kiwi dollar is down almost 1% at 69.02. So does this mean the dollar is really strong? Well, as I said, these fiat currencies take turn against each other, but being the reserve currency still, the dollar, people go to the dollar when there's trouble, but does that mean the dollar is a really solid currency? I don't think so. Anyway, back to the commodities now. We're seeing WTI crude continue to move higher. We're almost at 80 now. We're at 79.05. It's up 1/3%. The high's been 79.57. We're seeing Brent crude hit a high of 83.28. So there's no let up in the collapse of the currencies versus energy. Yes, collapse of the currencies. That's another way to look at it. It's not energy prices going up. We got natural gas here hitting 6.5, which, as you can see by this chart, is a really important technical level. It was the high back in 2014, and I think if we go through that 6.5, look out above. Yes, it's going to be volatile. It's probably going to correct a few times in the interim, back even below 6, but the trend here is higher for natural gas. So just have a quick look here at some other commodities, see if there's anything interesting going on here that I need to tell you about. Let's have a look. Oh, cotton. We've been covering cotton. Look at cotton. I mean, it's getting really silly now. Cotton broke through like 95 cents, as you can see here, which seemed to have been a really key resistance level, or 97 cents. And now we're almost at $1.20. So it's not just about energy, it's about the money going bad. And now we've got a credit squeeze, it seems, or the beginnings of a credit squeeze. And the thing that you need to understand, what trouble in the government bond market, be it US, UK, or European, will do, it will spill over into the lower graded bonds, corporate bonds, municipal bonds, mortgage bonds, and it disrupts the whole economy. I mean, if you thought things were pretty bad right now, think again. If yields continue to rise, if investors continue to get rid of their bonds. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to this channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.